Good afternoon, and thank you for joining us today. My name is Natalie Wolf. I'm the Director of Investments at Foundation for the Carolinas. And on behalf of the executive leadership team at FFTC, we thank you all for joining us today. If at any time during the webinar you have questions or would like further clarification on a specific topic, we invite you to post your questions in the Q&A window. The Mercer team will address these after the presentation during the Q&A portion of the webinar. And if we do not get to your question during the session, we will follow up with you after the webinar. This webinar is being recorded and the link will be added to the fftc.org website. You can access it by going to menu and the link is under Engage Events and Webinars. I will now introduce Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer. Travis will be leading the discussion and will address market conditions and investment performance for FFTC's investment pools during the second quarter of 2024. Thanks, and I will let Travis take it from here.
Great. Thanks, Natalie. And hi, everyone. Welcome back to those of you who have joined us before, and welcome to those first-time listeners. Tim and I will go through the portfolios today. So we'll start with a brief market overview. Our special topic for this quarter will actually just be more of a current events recap. We'll touch on a variety of things as if you will, a mid-year update, give some sense of where we think we're going. Standard pool performance we'll talk about, as well as some recent updates to managers and structure, or not so much structure, but asset allocation targets and implementation in the portfolios. And then, as Natalie noted, we'd love to have your questions and make this interactive for you. So I know my computer is running a little bit, slow today. So if it seems I've paused, it's because I've paused. So if we start with a broad recap, all in all, it's been a really pretty good year at the highest level for equity securities. And so you can see U.S. equities, which is measuring the broad U.S. equity market, both large and small, for the quarter, was up 3.2%. But you can see that there was some divergence, and there has been, and we've talked about the last couple of quarters, this notion of leadership amongst the larger stocks. And I'll talk more about that in a minute, but clearly, as you look down the page, the primary leadership really came from the growth side of the marketplace. So again, this is all growth stocks in the U.S., really helped push the needle. Small cap stocks, value-oriented stocks did have a difficult quarter on an absolute basis and on a relative basis. And again, really driven in large part by some of those largest names at the top of the index. And maybe rather quietly, as I was putting this together, I suppose maybe it hadn't jumped off the page to me before, but emerging markets actually had a nice rebound in the quarterly period, up 5%, with better performance across some of the markets outside China, but really perhaps a bit surprising in the strength with the strength of U.S. markets. As we work down the page and we get to the bond market on the bottom, or the fixed income market at the bottom of the page, U.S. Aggregate Bond Index, which is our primary core investment grade fixed income benchmark for your fixed income portfolios, was basically flat over the course of the quarter as we saw rates move around a bit again. The to and fro of inflation expectations and the then concomitant potential for rate cuts has been the story of, well, basically the last 2 years, and it has picked up continued heat here since the end of June. But what that has meant is a fair amount of volatility and not a lot of return for core investment grade bonds. Given the market has demonstrated some appetite for risk, you can see some things like high yield, hard currency, emerging market debt, leveraged loans, which are loans to lower quality borrowers. All of those have continued to perform sort of in line with the bigger indices from an equity perspective. And then we've got a mixed bag here in the real assets. So I'll give you an update on that. I think we talked about it last quarter, but I'll give you an update as to where we sit on those views. So from a year-to-date basis, then, the global equity market's up about 11%. And so that's, in the grand scheme of things, that's pretty darn good for a 6-month period. But again, the story is the same. Growth has been the leader over the 6 months and really certainly was back in 2023. But positive, at least mildly positive returns for things like small cap value through the 6 months ending June. Just as a sneak preview, in the month of July, small caps are up something north of 10%. In fact, much of that came in a 5 or 6 day period in the middle of the month. That's pretty dramatic, and the the magnitude and velocity, those are probably the same words, of the movements in small cap stocks, and particularly and coinciding a bit with some sell off in some of those larger cap names, pretty violent and pretty short term in nature. I think it will be interesting to watch how that develops through the rest of the quarter and for the year. Today is of course Fed Day, so we'll have some additional noise here in actually just a little more than an hour's time as a result of the Fed's comments around where they think interest rates are going to go and whether the market continues to have a high likelihood of cutting rates in September. And then I mentioned, not a lot of return out of the bond market for the 6 months of the year. First 6 months of the year, aggregates up maybe almost 2% in the month of July alone. However, so we have seen again lots of volatility in certain places in the marketplace, and what could be, albeit I think too early to say for certain, certainly early, green shoots in terms of potential market leadership change. But I think today's commentary from the Fed and future action and activity around inflation will matter an awful lot as to, what leads the way. I did mention just a different take on this leadership view, just to paint it in a different prediction. This is the trailing 3-month, year-to-date, and 1-year number as of June for U.S. large cap, mid cap, and small cap stocks, and then value and growth stocks in the U.S., and then developed and emerging markets outside the U.S. And you can certainly see over the last year being big cap in the U.S. and being growth, definitely where you want it to be. The absolute returns over the 1-year period, it's hard to be disappointed with double-digit returns out of the other categories, but clearly market leadership has rested in those biggest, growthiest names in the marketplace. And as I mentioned, we're seeing now some signs, some reversal in the small cap, mid cap space, and in value, quite frankly, here in July, that are pushing it would push these numbers a little bit higher if we were updated through year to date. But I think that's key. If there is a sustained change in leadership within the U.S., it will probably be violent, and it probably will have reversals as the market sort of finds its next footing. But this has been key to performance going forward. And as I mentioned, emerging markets actually quite quietly moved into a pretty good result, right? And that's driven with places like India and the like. 13% over the last year, a bit ahead of developed EFA markets. But again, all in all, pretty solid absolute results to help support your portfolios, your organizations, and the efforts that you support with your pools of capital at the foundation. So where are we going? Just some quick thoughts on this. We have seen a fair amount, that one of the challenges, I think, in looking at markets today and thinking about the possibility of rate cuts is to also look at the fact that many forecasters have changed their view as to whether we are actually going to see a recession, whether are we going to see an economic slowdown. And there are clearly some signs at the margin that the U.S. economy is slowing. But there are just as many signs showing that it seems to be just fine. And so forecasters, I think, are caught in a conundrum there. And I think it does create a bit of a non sequitur between, views on rate cuts and views on economic output, and then ultimately how that might translate into stock earnings growth. So particularly in the U.S., forecasters have definitely developed a much more sanguine view in terms of economic growth, while still having relatively dimmer views for the full year of 2024 for places like the Eurozone, UK, and Japan, but sort of flattish growth throughout 2025 is still the overall expectation. Inflation does seem to be coming in, and I think it's going to be probably the most watched. If it hasn't been, it will probably be the most watched statistic here for the next several months, as investors continue to look and see, is that 2% target achievable and sustainable? And we're getting closer in a lot of ways, and that has been taken by a signal that once we get there, that the Fed will be active, and I think that remains to be seen. But that is certainly having some influence in the near-term market environment. And then employment, has labor markets have loosened some over the last quarter, but we're still looking at unemployment rates of 4.1 to 4%, in part because immigration has moved up, so we just have more workers in the workforce. We're seeing at the margin, we're seeing pickups in continuing unemployment, but from a long-term historical basis, the labor market still looks like it's in pretty good shape. So, again, just some of these countervailing views or some of these things, we are getting weakness at the margin, and it will be important to think about how does the Fed and how does the federal government, react to such things. So we wanted to we've written a few interesting papers here, and so I wanted to grab a couple of comments or concepts from these for the conversation today, particularly around this notion of expectations around rate cuts. And we looked at some historical times when the slope of the yield curve was negative, and what the period immediately prior to the first rate cut, the slope of the curve looked like, and what it looked like afterwards. And in fact, we even took a look at some performance numbers to see if we could draw concrete conclusions. And I think the number one item on this is that history is really an imperfect guide to how rate cuts will translate into or out of economic growth. So just running through each of these examples briefly. The blue line is July of '95. So for those of you, this is near the beginning of my investment career, and we saw this chart shows the slope of the curve between 5-year and 30-year treasuries. So just give you a sense of, if you will, sort of the belly of the curve. What do financing rates look like for commercial and personal borrowers? And you can see that in mid 1995, the yield curve was inverted out at the belly of the curve, but up to this point of zero, which is when that first rate cut, it actually had kind of flattened out and stayed flat for the intervening period. So it's still not a tremendous amount of steepness in the curve at that point, even after that first rate cut. Similar in January of 2001, actually a much shallower, a much earlier inversion of the 530 curve, and the curve actually steepened pretty significantly even before the first rate cut. And if you'll recall, let's see, 8 months before January of 2001, we were just in the beginning phases of post 1999 and post TMT and post Y2K, and so the environment changed pretty significantly after that, and we did see the curve get pretty steep. And so the similar activity in the purple, which is September of '07, which as you may recall resulted, that time period and that environment ended up in the global financial crisis, and then in 2019 where we had a bit of a pivot. But you can see that each of the rate activities was very different, and I think it makes it more difficult to draw concrete conclusions. I think additionally, come on now. Sorry, computer is stuck. There we go. We took a look at performance for, there we go, the approximate 1-year period following each of those rate cuts, just to see, is there any trend that we could draw strong expectations on for the next year? If let's say that the Fed did cut in September, what might we expect? And I think that the big takeaway here is it's unclear. History doesn't really provide a really great guide, right? So June of 1996, that was a very different time. We were just getting started with the technology revolution in earnest, if you will, in terms of equity markets. And 1996 ended up the second of 5 straight years where the S&P 500 was up more than 20% a year, driven in large part by large company gains and big, international, global leadership from S&P 500 businesses. And you can see that short bonds, which are green, aggregate bonds, which are purple, S&P is red, and small caps in the form of Russell 2000 is blue. You can see that by and large, it didn't really matter what you owned. You actually did really pretty well after that first rate cut. In January of 2002, for the 1 year after that first rate cut, take yourself back. Certainly, we had the bursting of the TMT bubble as we saw a lot of technology spending brought forward in preparation for Y2K, and then that correction or large sell-off in that period in which the S&P 500 in its base lost half its value was complicated by, or not complicated, that's the wrong word, was exacerbated by, of course, the tragic events of 9/11. And so over that course of that 1 year period, ending that first rate cut, you were much better rewarded to own bonds if you could have seen the future, and which bonds you owned didn't really matter, but certainly owning large cap US stocks after such a tremendous run we did end up giving some of that, a fair amount of that back. And that was a pretty painful period of which we bounced off and we rode into heading into the 2007, 2008. And again, similar moment in time, S&P 500, more, actually, frankly, stocks in general lost about half their value over the course of that period. And being actually shorter term bonds coming out of that environment was a better place to be because, as you'll recall, we were perhaps over indebted in certain parts of the global economy, and that caused some real challenges to the economic environment, to the stresses on our financial system, and that was reflected in security prices. If we contrast that with 2019, again, very different place. Economy is actually in pretty good shape. Inflation is well under control. We had a bit of a pivot at the end of 2018, which held rates sort of steady longer than we thought. Then we got our first cut, and being in intermediate bonds and S&P securities actually was the best place to be over that 12-month period. So I don't think, just other than just giving you a history lesson, so there'll be a test at the end. The point here is that each market environment is very different. You can get some kind of guidance from the past, but each economic scenario matters an awful lot in terms of rate cuts and the shape of the marketplace. So if we were to see a rate cut in September, under the notion that, hey, inflation's under control and we can provide a bit more push to the economy, if the economy is still in pretty good shape, one might presume that we would see pretty good results there. If we get a rate cut because the world has fallen on its head over the next 2 months, it just becomes a very different outcome. So last notion on this, just to give you a sense of some forward-looking views. So these are based on Mercer's capital market assumptions. These are our expectations for returns over the next 1 year period. I will enforce and reinforce and say again, these are basically just to provide an illustration of the potential that could happen. Certainly can't guarantee that any of these results would come true, but certainly with things like bonds, because of the rate, the more certainty is the wrong word, but the way that you can estimate forward returns on bonds, we get at least a good, decent picture of what directionality might look like under each of the future paths. So if we think about our base case, or return to a stable rate environment, differential between short bonds and intermediate bonds, maybe not all that remarkable. That would suggest either staying in a inverted yield environment, or maybe modestly flattening over the yields over the course of the next year. So all in all, that's probably relatively benign in terms of return potential for both bonds and stocks. If the economy overheats, so that if inflation doesn't indeed float down to 2%, but actually picks back up, and the Fed is either forced to hold rates here longer or perhaps even raise farther, then short bonds is probably a little bit better place to be. Ag bonds, because they have longer duration, would have a slightly negative return, and it wouldn't be a great place. Probably wouldn't be a great time for stocks and longer term bonds. If though, however, we actually did finally see a recession or a much harder economic landing than we've experienced thus far, that'd be a much better environment for longer term, intermediate and longer term bonds. Probably still not a great place for equities, because if we get into a recession, then you would expect earnings pressure across the economy, and so that all things being equal, we should expect that to put pressure on stocks if in that environment. So there's as I'm looking at it now, there's the 2 out of 3 aren't awesome. So we are pulling for stable in terms of the stable environment. We do have in our long-term portfolios, we do have a modest position in shorter term bonds relative to a long-term target. And we often talk about, how do we think about that? Why do we have that on? And I look at it and explain it this way. Realistically, if we overheat, then we provide some protection in the portfolio, and we're happy with that. If we do hit a hard landing, we give up some upside potential, but it's really opportunity cost. And to have some inflation, or to have some, if you will, quote unquote, insurance in the fixed income portfolio to help protect if the market goes against current market expectations, is worth some modest amount of opportunity cost given the position that we have on. So if you're thinking about those things, or those things come up at your organizational meetings, happy to talk about that more. But just to give you a sense of where we think the world, the scenarios that the world could see, again, primarily based on directionality. Okay, so if that didn't roll you up, the next part will. So we can't enter an election year conversation. And in fact, we may not. I can't remember when our next webinar is scheduled, but it's going to be right around the election, I think, the next time around. So we did want to talk a little bit about the impact of elections and the shape of the U.S. government on returns. And that is really all we're going to talk about today. We're not making any prognostications. We're going to stay away from partisan items, but we just wanted to take a look at, on average, since 1940 through the end of 2022, what's the S&P 500 done in the first, second, and over the 1 year, 2 year, and 3 year periods following a particular election cycle. And so this is a very simple analysis. There's all kinds of potential shortcomings. So this is really just to give you a sense of what's history looked like. And in the 1 year, there's a lot of differentiation, right? I think it's difficult to draw conclusions from this data, but generally speaking, there's a lot of differentiation between the different states that the U.S. government can be in. But on average, it's been about 11.5% return after the 1 year period. So all things considered, maybe elections are a little more of a non-event than we think them to be. Over 2 years and longer, though, it becomes very clear that the market likes stability and likes sort of less potential for change. And so when Congress is split, regardless of who the president is, that's when you really get actually the best 2 year environment, is when both houses of Congress are not controlled by the same party. And that holds true also for the 3 year annualized returns after an election. When Congress is split, when lawmaking has to be more balanced and or less potentially partisan, that is when we actually get the best election results, or excuse me, the best returns from the S&P 500, is when Congress is not able to act unilaterally on one angle or another. So I think it's interesting data. So that hopefully perhaps having some of this data available will help you think about the post-election outcomes. It certainly helps us, but like I said, it's just one data point to think about as we head into political season. So I will stop my history lesson and roll into current performance, and then we'll take some questions and comments. So we start with our more conservative portfolios, the liquid reserves, which are money market assets, low duration fixed income, and income and growth standard models. As I talked about, long-term interest rates did raise a bit in the quarter, and there was a lot of volatility. And that provided, as a result, an opportunity to generate some positive returns. So you can see in the second quarter, money market assets a little better than 1.3%. Yields there still are somewhere in the 5.25% or a little bit better range on an annualized basis. And that is definitely a nice change of pace if you need more conservative allocations versus, say, 3 or 4 years ago. Low duration bonds, again, because the yield curve is inverted, returns weren't quite as good, but overall still pretty okay. Our low duration fixed income option just a hair behind the benchmark for the quarter and in line for the year to date. So we're still very comfortable with those results. And then income and growth, which is 20% low duration, 40% core fixed income, and the rest in equity. Again, a pretty solid return for the quarter, a bit behind the target weighted index. And I'll talk more about some of the components, but a little bit of underperformance on U.S. equity for the quarter. Nothing terminal, but in a strong equity market, we're just not quite exposed enough to S&P drivers. But year to date, really strong, I think, strong performance for the income and growth strategy. So for those of you who have a slightly more conservative but intermediate term view, some better relative performance against the year to date. And I think absolute performance wise, pretty darn good for a half year period. If we look at the longer term pools, the ESG pool, which is one of the smaller pools and newer pools in the portfolio, but off to a good start, did lead the way this quarter, just primarily based on the strong active management exposure in the fixed income international equity. We continue to look at that pool and find ways to deliver better results, as well as deliver solutions that are consistent with those investors that would like to introduce more of their values into the portfolio process. Diversified long-term growth. As we talked about, the equity returns were strong, and so diversified long-term growth is our long-term endowment-like portfolio, which means it's got about 25% of its assets are in private securities, which don't mark as quickly as, say, the public markets do. So when we compare diversified long-term growth, say, versus active long-term growth, this is the kind of quarter and kind of year-to-date period, frankly, that we should expect, at least at this stage of the development, for diversified long-term growth to underperform. I think we're moving in the right direction with diversified long-term growth. We have made some changes to the building blocks I'll talk about in a minute, but some remaining underperformance in one or two pieces that we are in the process of liquidating and changing out, but participating on an absolute basis. Active long-term growth, really solid participation overall, in line with its benchmark over the first 6 months of the year, and ahead of the passive long-term growth option, which has essentially the same asset allocation as active. And so while they have slightly different benchmarks, which is why they measure differently, active long-term growth and passive long-term growth basically sit in the same part of the risk-reward curve. And so we're happy to see that the active long-term growth strategy is adding value, even in an environment where being passive and exposed to passive equity markets, particularly around the world, has been quite advantageous. So all in all, we continue to work very hard on your behalf to try to deliver better results at the right risk-adjusted profile. I think we're well on our way, and we will definitely be interested to see how the world changes here over the next several months, both in terms of what the world thinks about on interest rates as well as the upcoming election. So just real quickly, we have made some recent changes in the portfolio. So within the U.S. equity portfolio, and coming soon in the non-U.S. equity portfolio, we have decided to move away from the low volatility factor. So this is Martingale has done a very nice job in the U.S. equity portfolio in managing what is just a lower risk equity approach. And we have been evaluating that for some time and determined that while we like Martingale and the work that they have done there, we have determined that the lower volatility equity, which provided a lot of value in 2022 when equity markets rolled over, the opportunity cost that it creates long term when markets are generally up was more than we were comfortable with. So we did decide to take that out in June. We did reallocate that to the S&P 500 index. So now the structure of that portfolio will be passive S&P at about 85% and active small mid at about 15% of that portfolio. Within that 15%, we also recently terminated Aristotle. So Aristotle was our contrarian value component of the active small mid strategy. It was paired with GW&K, which we are maintaining, but we terminated Aristotle and we restructured the portfolio to be approximately equal between Victory small mid value and William Blair small mid growth. And so Victory is I guess they term themselves an all-weather value strategy, basically a strategy that brings some flexibility to the value style so that they're trying to buy stocks that they believe are cheap, but they're also trying to identify those stocks that maybe have very distinct catalysts and a distinct pathway to recognizing the fact that stocks are cheap and that the companies are on the right path. And that, we think, gives us an opportunity to perform better across a variety of cycles, rather than only being able to perform, say, in a cycle that rewards only the deepest value strategy. So we like the flexibility of that strategy. We think it pairs well with both GW&K and William Blair. William Blair is looking for companies that are growing above average in the small mid-cap space in the US, but they are, I suppose, somewhat similar. They are looking for quality companies. So they are looking for much more durable and long-lasting growth with companies that are at the margin lower risk. So, excuse me, they will generally underperform if a very low quality rally happens. But again, it's a strategy that we think provides better opportunity to produce positive excess returns across a wider range of market environments. And that, we think, helps the overall portfolios for FFTC better meet their long-term goals, and it creates a lot less noise for you as investors in the short term, as the market goes through the kinds of gyrations that we're experiencing today. In the non-US equity portfolio, I mentioned we are taking low volatility out as a factor, and so we're just in the process right now of also removing Acadian low volatility. Again, not a knock at all on Acadian. They have done exactly what we have asked them to do in this portfolio. But again, under this notion that low volatility, just the opportunity cost in the up markets is perhaps more than we were comfortable with moving forward. Also at a structural level, some of the longer term portfolios did have liquid real assets target allocations. This was an allocation that we owned between 5 and 10% of portfolios in liquid real assets under the notion that we would get some good diversification, which we did at times, but that we would have more sensitivity to changes in inflation rates and changes in inflation expectations. And when we lived through this most recent bout of strong inflation changes, collectively the group just didn't react as we had hoped it would, where there was more disconnect in the pricing of those securities in the markets relative to inflation than we had originally modeled. And so when that occurred, it caused us to reevaluate whether, again, the opportunity cost of owning these and having some additional diversification in the portfolio really justified the ability of those assets to provide some inflation protection. And we have determined that that's probably not the case. And so long-term public stocks do a pretty good job of protecting against long-term inflation because companies are generally over time able to pass through any price increases or cost increases in their businesses to final consumers, and so earnings can be protected in some ways against that. So we did elect to remove, we recommended, that was a strategic allocation change, so we did recommend that to your investment committees over the last couple of quarters, and they agreed to make those changes. We have updated the strategic asset allocation for those portfolios and remove those assets in June. And so we will continue to watch and make sure that that's the right decision. But we think long term that is the right positioning for the portfolios. And so with that, I will pause and we'll invite Natalie and Tim back in, and we'll take some questions.
Going off mute for a second. Thank you, Travis. For participants out there, attendees, please put your questions in the Q&A box. It is down at the bottom of your Zoom screen, and we will respond. So wait just a moment. Travis, before we don't have any questions yet from our attendees, but I'll ask you a question that I get a lot when speaking to donors. You spoke about how the more diversified pool, DLTG, has less public market exposure and has led to trailing the pool with more public market exposure, active long-term growth. And just can you talk about the performance of the private market exposure in diversified long-term growth, and also what Mercer expects, you touched on it, but what Mercer expects from that part of the portfolio and how it differs from the performance of ALTG. I get the question a lot, so I just really want to make it clear
Sure.
to everyone on the call.
Yeah, and it can be challenging. It can be a challenging thing to ponder. So it's a great question. So at a very high level, when we particularly around private equity, so traditionally that would include investments in a modest amount of venture capital, probably greater allocation traditional buyouts, and something in the middle called growth capital, which is growth companies, but certainly past the venture stage. We're providing capital to help those businesses to help those businesses grow, to help them transform, but outside of the context of the public markets. And there are additional risks and illiquidity that goes along with that. And because of those, if we're going to take those additional risks, we expect to get additional return over the long term versus public markets. And so our current expectations for, say, private equity above public markets is, call it 3 to 4 percentage points over time over global stocks. So this is a very simplistic form. If we thought global stocks over the next 10 years would deliver 6%, then we would expect to get 9 or 10%, somewhere in the range of 9 or 10% out of our private equity portfolio to justify taking the additional risk and illiquidity that goes along with private equity. But private equity doesn't price every day, and a lot of those investments are very long-term in nature. And in fact, private equity can create some noise in the short term, both positive and negative, because it isn't priced every day. It isn't reflecting the market's take on those businesses every day, like we get out of the S&P 500 or the Russell 2000 or the MSCI EAFE index. We get that immediate feedback from the market on every day as to what's going on in those companies, but private equity prices a lot less frequently. We get quarterly updates of value, and they're usually a quarter behind. So in our June numbers, we'll have March valuations, and that's just because it takes time to value those companies each quarter. And if there's been no sort of change in the business dynamic, those valuations might not change. So you have a company that's operating on its capital budget, things are going along fine, it doesn't need a financing event, it's not for sale. The private equity owner might just not change the value of that company because there isn't necessarily a lot of value in just changing those, adjusting those values often. So that creates a bit of a disconnect. And we will see in periods where the market runs up strong, the increases to valuations of those private companies will come along, but it'll take a couple of quarters oftentimes to catch up, if you will, on the upside. The same is true on the downside. So in 2022, we saw actually the diversified long-term growth model perform much better than the ALTG model for the reverse reason. Those valuations also don't necessarily get written down as quickly, right? We don't get the reflection of the public markets and the private markets in the same expression of time. And so we would expect, all things being equal, when equity market, particularly at this stage, and I'll come back to that point in a second, when equity markets really take off and go strong to the upside, diversified long-term growth is probably at the margin going to underperform active long-term growth and passive long-term growth. In markets where equities take a pause or they go through a correction, we would expect diversified long-term growth, all things being equal, probably to outperform active long-term growth over that period. Over the long term, we would anticipate, based on the structure that we've put in place, that diversified long-term growth would benefit from that premium that premium that we expect to get from private equity and generate a better long-term return than active long-term growth because their basic risk reward structures are very similar. But the last notion on that is just the age of the private equity portfolio. It takes time to get, if you're not familiar with the way private equity works, we make a commitment. So we say, we want to invest with a manager $1 million. That manager only calls down a portion of that capital when they're ready to buy a business, right? So maybe the first business that they buy only requires that they call $200,000 from our commitment, and that might happen this year. And then next year they got another company to buy, and they might call another $200,000. So it takes time to actually get that $1 million invested across a portfolio of businesses, and then it takes a while for that value proposition to work out. Maybe that business purchased in year one, maybe it's not actually, maybe they're not able to actually monetize that business until maybe year 6 or year 7. And as a result, just as we're getting the capital in place, we get the capital up, and then we also start to get capital back. We talk about that notion of getting the capital in and getting the capital out as the maturity of our program. And so we basically started anew with the diversified long-term growth private equity in 2018. And so we're only about 6 years into our first commitments, and we've done 3 so far. And the most recent are only basically 1 year and 3 years old. So we do still have a pretty immature private equity program that we continue to build on, continue to watch. And those initial private equity investments actually started to see some distributions today. We've seen nice valuation adjustments to valuation over time in the direction that we want to see them in. So It'll take a little bit longer to get maturity on that portfolio, but we do think over the long run that structurally, diversified long-term growth should, generate a performance premium over long periods of time versus a active long-term growth.
We're just waiting.
We're just waiting. Not sitting on our hands waiting, but we are.
Yes,
we are,
no,
we
we're
are
not
just
sitting.
waiting. Yeah.
We're not sitting on our hands. So yeah, in that vein, we didn't have a question, but I guess we'll end on this compliment for you, so that we have a nice to see what actions you all take around managing the managers of the portfolio. So just
Thank you very
referencing
much.
back the manager changes you're making is appreciated. So
Thank you very much. Very much appreciate.
So thank
those
you for
kind
being
words.
here. Thank you, all the attendees, and thank you, Travis and Tim, for sharing your insights with us on markets and performance. We hope you found this webinar insightful and informational. And just a reminder, we'll be posting a recording of this webinar to my FFTC /resources. Thank you, and hope the rest of the week is great for all of you.
Thank you. Thank you again for joining.
Thanks a lot.